Figure 1 of the weekly sentiment forecast report shows the past 52 weeks for the asset being analyzed and includes a forecast period for the physics-based drivers. This example uses the ETF RSP, which tracks the S&P 500 equal-weighted stock market index. The lower panel displays the physics-based drivers for the asset, while the upper panel presents the asset's price and our market resilience indexes. In the lower panel, you'll see 4 physics-based drivers. The top 2 are the main drivers, and they're always present. We call these cyclic drivers because they move gradually around a center line. While transitions are marked for specific weeks, keep in mind that these changes happen gradually. This means their effects might be felt a little earlier or later than shown. The long-term driver, shown as the purple line, highlights shifts in naturally occurring sentiment that don't happen very often. The periods between the shifts last anywhere from about 3 months to 2 years and reflect long-term trends in naturally occurring sentiment. We currently show 4 different conditions for this driver, ranging from strongly optimistic marked by 2+ signs to strongly pessimistic marked by 2- signs. The short-term driver, shown as the red line, is another cyclic driver. Its shifts happen more often, with periods between shifts lasting anywhere from 1 week to several weeks. For this driver, we show 3 different conditions: optimistic, neutral, and pessimistic. You'll also notice green lines appearing above and below the short-term driver from time to time. These are what we call confirmation lines, and they highlight periods when market prices are more likely to be influenced by the short-term driver. Investors with a short time horizon may give more importance to the short-term driver. Those with long time horizons may give more weight to the long-term driver. The 2 drivers at the bottom of the lower panel are called episodic drivers. They tend to have an impact over more narrowly defined periods. The flash driver, shown as the yellow line, highlights times when gradual changes in investor sentiment and market resilience are disrupted. These disruptions often lead to sudden market movements. There's a strong statistical correlation between market index price changes and the multi-week disruptions identified by the flash driver. The nature of these flashes can vary from one episode to the next, and our text descriptions will outline what to expect as these episodes move into the forecast horizon. Taking advantage of these episodes can have a significant impact on investment returns. These episodes are important to all investors. The minor flash driver, shown as the rose line, identifies brief bursts of optimism and pessimism that last generally a week or 2. This driver can be a catalyst for a more meaningful change in market price trend when it happens at the same time as a shift in other drivers. For most investors, these episodes should be considered alongside other drivers and serve as confirmations of other naturally occurring shifts that influence investor behavior. The long-term, short-term, and flash drivers are key for most investors, and their effects combine. Optimism from one driver can offset pessimism from another. While the flash driver occurs less frequently, its impact can be so strong that it outweighs the effects of the cyclic drivers. It is important to keep in mind that these drivers are completely exogenous and independent of the various capital markets. You'll find the forecasts for these drivers in the light green box at the far right of the lower panel. Depending on the report, these forecasts can range from 2 weeks to 6 weeks or even longer. Interestingly, forecasts for the episodic drivers, like the flash driver, tend to be more accurate than those for the cyclic drivers. This is because the cyclic drivers shift more gradually over time. To the right of the forecasts, there's a comment box that highlights noteworthy points about the forecast. In the upper panel of Figure 1, you'll see the asset's price level represented as a dark blue line, covering the past 52 weeks. We don't include a scale for this line because the focus is on relative price changes over time. You'll also notice 3 lines representing the Market Resilience Indexes, or MRI, for this asset. These indexes are derived entirely from the asset's price changes and measure return acceleration over time frames ranging from a few weeks to several quarters. The MRI are designed to help identify trends and key inflection points in investor sentiment and overall market resilience. They signal attractive short-term and long-term opportunities to enter or exit the stock market. The micro MRI is shown as the brown line. This indicator highlights shorter-term price trends, typically lasting several weeks, and tracks the week-to-week movements of the market. It moves in cycles, with its slope, or trend, and its level being key indicators. Its current level is represented by a score ranging from 0 at the low end to 100 at the high end. Both the current score and slope, whether positive or negative, are displayed in the legend. A trough at a low level signals an attractive short-term buying opportunity, while a peak at a high level indicates an attractive short-term selling opportunity. The macro MRI is shown as the light blue line. This indicator tracks long-term trends in market prices, typically lasting several quarters. Like the micro MRI, its current slope and level are key indicators, with the current status displayed in the legend. A high level followed by a shift to a negative slope often signals an impending long-term downtrend. The exceptional macro MRI is shown intermittently as the dark blue line above the macro MRI. This indicator appears when the slope of the macro MRI is likely to become more positive, signaling increased market resilience. Its current status is displayed in the legend, with yes indicating it is present and no indicating it is not. When present, the exceptional macro can reduce the negative impact of pessimism associated with the micro or macro MRI during the down legs of their cycles. When the exceptional macro disappears, the macro MRI may remain positive but with a decreasing slope. After being present for an extended period, the market often falters briefly when the exceptional macro ends but can resume its positive long-term trend afterward, all else being equal. The MRI are additive. When the micro and macro MRI are in the up legs of their cycles and at relatively low levels, and when the exceptional macro is present, the market is most resilient and able to recover quickly from bad news or negative events. Conversely, when all are in the down legs of their cycles, the market is least resilient and most vulnerable to declines when bad news or events occur. Historically, the MRI follow the paths of the physics-based sentiment drivers during times of economic stress or crisis. During these periods, active traders collectively tend to follow these emotional paths. However, during periods of strong positive economics-based sentiment, the market and the MRI proceed without being heavily influenced by the physics-based sentiment drivers. The long-term driver is calibrated to explain key inflection points in the macro MRI, and the short-term driver is similarly calibrated to explain key inflection points in the micro MRI. Keep in mind, if there is no economic need for a price change, shifts in the drivers may have little impact on the MRI or stock market prices. Visit our website to learn more. Contact us with any questions or sign up for a trial to receive our reports directly in your inbox. Thank you for watching.